much for tuning into Talking Point. I'm your host, Neeraj Shah, and the devils of higher inflation, higher yields, if not the geopolitics, in a small way, have returned. This day we look at events minute by minute, hour by hour, and week by week. So I'm sure our guest today doesn't quite look at them that way, but that's the point. That's the talking point today. How does Harsha Upadhyaya, how does Kotak AMC decipher the current scenario from an equity investing perspective? Harsha, great having you. Thanks for joining in.
Hi, Neeraj. Pleasure.
So, Harsha, tell us, we kind of hit and saved by a set of indicators which keep on changing almost every single week. How are you looking at the situation currently? And based on what I presume would have been a great month of March for inflows, have you invested yourself fully? I'm guessing as a mutual fund, you would probably be doing that. And are you confident of earnings growth as well as multiples sustaining within your invested universe due to all of, despite all of these uncertainties?
Neeraj, clearly last few weeks have been very, very adverse from a macroeconomic point of view. There have been geopolitical issues, as we all know. There have been commodity cost pressures that have been only increasing by day. We have also seen most central banks turning more hawkish than what the market consensus was. So all in all, I think things have been pretty bad from an economic point of view. However, our Indian markets have been quite resilient. As you would have seen, March was a month where Nifty went up by almost 4%. Mid and small cap indices went up even more than 4%. So clearly, there has been a pullback and a sharp one, despite all odds in terms of how commodity cost pressures are going to behave, both on inflation as well as on corporate margins. As we see it, we clearly think that there are issues on sustaining corporate profitability margins as we go forward. It was already visible in the previous 2 quarters. It will also be visible in the March quarter results that are going to come by very soon. I think the bigger impact and more adverse impact would be seen in first quarter of financial year 23, because we have seen further sharp increase of 20-30% across commodities, and it's going to be very difficult to really pass on all of that to the consumer. So I would say when you look at market, there are a couple of sectors which are going to gain from it, that is metals and some section of oil and gas, etc. There are a couple of sectors which are neutral to relatively less impact, I would say, IT, BFSI, etc. And a host of others will have negative impact. So that's the worry that we have. And once you believe that some of the companies are able to pass on this cost increase, then you have to worry about whether the demand is going to sustain at higher price levels or not, because the recovery is still shallow. So to that extent, one has to be careful in assessing how it's going to impact demand. So these are some of the questions that we have in our mind. As of now, if you look at consensus estimates, consensus has not downgraded numbers for financial year 23 or even for Q4 of financial year 22. But our belief is the current estimates of 18-19% earnings growth for Nifty is going to be difficult to come by if the current high prices sustain for a few more weeks.
Got it. So Harsha, okay, 2-3 back-to-back questions. First, at about 15,500, 16,000 levels, one could have argued that some bit of the pressures have been priced in. When I look at our markets currently, circa 18,000, do you reckon that the markets are being a bit lenient to the upcoming stress in profitability in India?
Yes, Neeraj, that's what I mentioned. I mean, if you look at the market, it belies all the volatility that is there in commodity space. It also masks some of the geopolitical tensions and how severe it's going to be in terms of overall impact on trade and commerce as we go ahead. So there are several of those concerns which are still very, very pertinent, but somehow markets seem to have shrugged off all those concerns. And also, if you look at FII selling, for example, although they may have turned buyers in the last couple of days. But if you look at entire last 6 months, they have been on the selling side. In fact, March itself, they have sold in excess of $4 billion. And despite all of that, our markets have moved up. So now when we look at India, within the emerging markets basket, India has clearly been trading at higher valuations. And also the outperformance of India still continues to be very strong as compared to many other emerging market indices. So to that extent, I would think that whenever there is nervousness, whenever there is selling across emerging markets, India will again see another bout of selling from foreign institutional investors.
Somebody
You had out, sorry.
No, I was just saying, because I'm just stressing that somebody's making this point that if one looks at Asia ex Japan, China continues to trade for throughout history at a valuation level which is at a particular level to India. India continues to trade at a premium to some of the other EMs. So his point was that yes, it is a substantial premium, but when is India not traded at a premium to most other ASEAN markets?
Neeraj, I'm not just talking about valuation premium of India. I'm talking about the magnitude of that valuation. That's at record levels. Yes, we all know that India has always been a premium market compared to many other emerging markets simply because of the size of the market and the democracy that we have and various other things. But today, when we are looking at outperformance of India on a 1 year basis or on 2 year basis, it's very, very stark. I mean, the point to remember is India weight in MSCI index used to be about 8.5% a couple of years back, and today it stands at about 12.5%. So that's a substantial increase that has happened within the emerging market index. And if someone is overweight on India, they would be holding anywhere between 14-15% in India itself. So for a emerging market fund to hold such a large position is something that I mean, people will critically evaluate it at every point of time. So to that extent, I mean, I'm not saying that there is going to be definitely another round of selling, but I'm saying the kind of outperformance that India has given leads it to some profit booking at various points of time.
Point well taken. Harsha, a couple of other questions. An argument that is made quite in almost a throwdown fashion on social media, that FIs have sold so much and yet Indian markets have withered the storm. Now what will happen when FIs turn back to buying? Now it's of course a big question, and I think Sanjay Mukim was making the point that maybe another $10 billion of selling could happen as well. But for the layman, the argument, Harsha, that despite such incessant selling for the last 6 months, if we have weathered the storm, and in part courtesy to you guys, because the money flows that have come into domestic mutual funds and from the retail public directly has been pretty strong. Is that an argument to ponder over? And how do you look at that argument? Because at some point of time, the foreign investor will stop selling, will return. I mean, leave out these last 4 or 5 days, but I'm just saying as a trend that will turn, right?
Neeraj, I agree to your point that liquidity and fundamentals both are important to have a outlook on the markets. But as far as liquidity is concerned, beyond a level, it's not going to help markets, and fundamentals have to really support the markets, because beyond a particular valuation level, for example, even if there is more liquidity, I don't think that will keep markets in terms of higher prices and higher levels. So to that extent, what we are really concerned today is not so much about liquidity, although I pointed about the relentless selling that we have seen from the foreign institutional investors. As you rightly pointed out, that has been more or less counterbalanced by domestic flows. What we are really worried is the adverse impact that the commodity price surge will have on the earnings. If you look at last couple of quarters, we have seen no earnings revisions, because the market was anticipating some sort of a higher levels of earnings as compared to estimates, and that didn't come through, and we have not seen any upgrades in terms of earnings for either FY22 or FY23. Now we have a serious situation where over the next couple of quarters, if commodity prices remain at these levels and keep putting pressure on margins, then you could have a situation where there will be earnings revisions on the negative. So that's the worry that we have. And all this is happening at a point of time where interest rates are starting to look up, right? And there is an inverse relationship between equity valuations and interest rates. And we all know that equity valuations worldwide, including India, have gained because of lower interest rates over the last decade. And that has started to turn other way. So that's where if at the same time, if you have earnings pressure also coming through, then whether the current market multiples will hold or not is a big question.
Harsha, I couldn't agree more with you. I'm just trying to play the devil's advocate because that's my job. So one question then, what are you penciling in? What are you bracing for, and how are you doing that? Are you tempted to sit on cash even if you can't, or are you sitting on a little bit of cash? And conversely, are you parking yourself in areas more where there could be weathering of the earnings cuts, like you said, metals, oil and gas, etc.? Are you doing that as well?
Neeraj, clearly cash levels have increased a bit, but that's not something that will move the needle. Maybe on an average, we used to be at around 2.5% cash across our portfolios. Maybe that level has gone to maybe 3.5% or so now. Only last few weeks of inflows may have got delayed in terms of deployment, but otherwise, I mean, as our investment philosophy, we really do not try to use cash as a tool to manage performance, because
But
it's
are you
always
tempted to sit on cash? I mean, if you had the choice, would you sit on more cash?
no, we will go gradual. I think that's what we have been doing, and especially at current market levels, we will be all the more cautious in terms of picking the right stocks and sectors. And as you pointed out, there are very few sectors which are benefiting from the current commodity price surge, and those are some of the names that we already have in our portfolio. Continue to hold on to them. There are also other names where we think, while it may be a short-term glitch in terms of corporate margins, because of the pricing power that the industry has or the companies sustain, they should not be a longer-term impact. And in fact, that's going to be beneficial for them in case there is too much of a fragmentation within the industry and others are going to suffer more than the established ones or some of the names that we like. Those are the pockets that we continue to look for opportunities. Not at every level, but I think the market has been giving opportunity with a lot of volatility on the downside in the last six odd months. So those volatile moments are the ones where we try to build our positions a little bit more in some of those stocks. And then there is another set of companies which are generally very consistent, not really looking at external environment, but they keep growing at a certain pace and certain profitability levels. And those are the consistent compounders, as we all know it. And those happen to be part of our portfolio anyways. What we are not looking to invest into at this point of time is clearly some of the sectors where there is commodity price inflation-led margin pressure, and also the valuations are high. For example, the entire consumption space, whether it's Fmcg or consumer durables, clearly there is going to be adverse impact on margins. And if the margins are to sustain, then there could be pressure on demand, right? Because the demand has not been so strong that you will be able to pass on all the cost hike. So those are the pockets where we are not so comfortable, because the current level of valuation may not hold up if there is earnings revision on the downward side. That's been our thesis.
Got it. Actually, first a bit of a question to what you just mentioned, and then a word on some of the other companies. Fmcg, while this conversation of the kind of margin impact that will be seen and maybe even slowing volume growth, if Mexico was anything to go by, so to say, my question to you would be, because of this whole belief of how the agrarian exports due to the Russia-Ukraine situation might revive rural income and rural demand, and thereby FMCG volumes sooner. I saw a couple of notes which went from underweight to neutral on staples. Are you as benign on that, or do you doubt the pace of that showing up for the staple companies?
That's a possibility, but I would say that the probability of things getting worse before it gets better are more. So to that extent, we would not really venture out and invest at these valuation levels. Either there has to be a significant correction in valuation for us to reevaluate, or there has to be a positive change in fundamentals. Without that, then I think it becomes difficult.
Okay. Harsha, I have two more questions and then we'll let you go. One is, I'm using defense as an example, but it could be extended to some of the other industries as well. But here's an industry which the input cost pressures will certainly hit it, but the order books are looking very strong. Execution is very bottom up, but let's assume that execution is looking okay. They've ended, a lot of them have ended FY22, the HALs, BLs of the world have ended FY22 with all-time high sales, all-time high order books as well. But they will be hit by margin cost pressures. Do you think that the markets will look through that bump for these set of companies or maybe some others for a quarter or two, or will they also stand to get punished in what will arguably look like a bleak margin picture over the next couple of quarterly reports?
Neeraj, clearly most manufacturing companies will face this margin issue. But I think in case of defense manufacturing, there will be contracts where some amount of cost escalation will be built into those contracts. If that is the case, and what is the proportion of that in each company has to be evaluated. Because from a demand perspective, demand is unlikely to change due to this commodity cost pressure, at least in the defense manufacturing space. So that's a positive compared to many other areas where demand may also collapse if there is a change in commodity prices and price increases, etc. So to that extent, I would say within manufacturing, this seems to be a better place, both from a long-term sustainability of demand as well as managing what's going to happen in the very short term in terms of margin.
Right. Harsha, my final question, and that is linked to manufacturing as well. We're thinking of doing some stuff on PLI, and I wanted to understand from you, of all the 13, 14, 15 sectors that are there, which have gotten these PLI benefits, and that's squarely manufacturing, where do you think the best bang for the buck is coming, where companies might be executing, where your analysis suggests that the demand, either globally and locally or both, will look fairly strong, and the roadmap seems to be pretty clear of earnings growth and production growth over the course of the next 3 or 4 years. Out of whatever you've analyzed between whatever has been dished out, where is it that you're the most constructive on? And where is it that you're least constructive on?
See, clearly, most PLI-related sectors will see an upside because these are essentially the sectors where the demand is definitely going to be there. And it was a question of whether we have a scale that is going to give us benefit in terms of global trade and commerce, as well as in terms of cost of production of those materials. So I think every industry that's part of the PLI scheme is going to gain. It's just that not all of them have seen introduction of PLI at the same point of time. So some are ahead of others. So we clearly think that electronics manufacturing or contract manufacturing is a space where we will see more benefit coming through in the immediate term itself, as compared to some of the others where the benefits will come, but maybe they'll come with a lag of 1 or 2 years because they've all started to invest now. So to that extent, I mean, we do hold some positions in contract manufacturing in our portfolios, in our mid and small cap strategies, and continue to be quite positive. And the numbers have started to show that uptake already.
Got it. Harsha, this was lovely talking to you. Thank you so much for your time today, and look forward to, of course, having you more often on the forum.
Thank you, Neeraj. It was really a pleasure talking to you.
Thank you so much. Thanks for tuning in.